One is financial stress, mental stress, emotional stress. Something could always go wrong. The other one is do nothing, like literally nothing. The purpose of this video is to introduce myself to you and how I came to this point. Go over some real numbers so you know I have done single families and that syndication is good, like really good. My background is I graduated from Duke in 2010 with a degree in computer science. Then I became a software engineer in some well-known companies like Amazon, Twitter, Lyft. Spent 5.5 years at Lyft. Became a staff engineer, then became an engineer manager. I got into real estate investing when I bought my very first condo in the Bay Area 5 years after graduation. In fact, I haven't paid off my student loans because the student loan was like 7% interest rate at the time. And I figured I could make more than 7% return in real estate investing. So I still pay off, a little bit each month, but I decided to save more money for a down payment for a house. So 5 years after graduation, I bought a condo in the Bay Area, $750,000, 20% down payment. So $150K of down payment. Sold that for $900K 3 years and 3 months later. And my IRR is, let me check. I actually have this written down in a spreadsheet. So these are all real numbers. My IRR on the deal is 15.92%. So keep that in mind, 15.92%. And it's over the course of 3.25 years. For those of you who are new to syndications, IRR stands for internal rate of return. You can think of it as compound annualized return. It's not exactly that, but it's very, very close to it. The technical answer is the rate in which the money grows, assuming the present value of the money is zero. It's like complicated math, but it's approximately annualized compounded return. So I got this bug, so I started reading Rich Dad Poor Dad. I started listening to Bigger Pockets podcast, graduated in 2010, so this is 2015. And the very first primary resonance, what I did with that was I house hacked it. It was a 3-bedroom condo. I live in the master room and I rent out the other 2 rooms. And the decision calculus is that it's enough to pay for my rent. So that's it. I created a spreadsheet, but I didn't know anything about investing. It's just like, okay, this is cheaper than my rent. A funny anecdote on that is I actually live in the medium-sized room and the smallest room. So I live in all 3 rooms throughout that course. Because as time goes on, I became more and more frugal, which is kind of funny. Anyway, so back to the story. Something is boiling, inside of me where like I actually like this real estate thing. But the Bay Area is really expensive. I couldn't buy any other house. So 9 months later, I bought another house hacking house in Seattle. I bought it for $415,000 and we haven't sold it yet. I think it's worth, let's see how much it's worth today. It's worth like $720K in today's market. I will have ended up with a 23.35% IRR. So that's, it's better. And it has to be better because every time when you look at these Bay Area houses, they're like really good. But when you do the math, it's like 16% IRR. Maybe the lesson here is to get double-digit IRR is not easy. In fact, it's extremely hard. Don't take good IRR for granted. Your stock market is very close to 8% IRR, maybe even 7.5% IRR because IRR is a little bit more strict. That's the basis of comparison. You can see my San Francisco condo, 15%, 16% IRR is twice as good as the stock market during that period. And so 9 months later, I bought another house and put down 20%. I bought it for like $550K. It's worth like $850K today. And the IRR will have been 22.16%. Now going down the list, 9 months later, I bought another single family. That one is funny. This is like January of 2019. There was this fear of recession. Everyone's like, this is a super hype, like overhype. So there's a recession coming. The house was listed for like $650K. I bought it for $575K. Very proud of that. And I sold it. When did I sell it? And then I sold it on March of 2022. So literally the peak of the market. So I bought at the deep of the market, the fake recession during that period, and I sold it like right before everything kind of blows up. The interest rates start rising, all that. The IRR on that one, probably one of my proudest properties, is 35.22% IRR. So yes, we crossed the 30% IRR finally. And If you watch this video in the upper right hand corner right here, you will note that 30% IRR, sustained at 30% IRR is like magical. Like nobody does that. It's like unicorn mythical status. And you can turn $100,000 into like 200 million with the 30% IRR, sustained it over the course of 30 years. So be able to generate 30% IRR is like not possible. I was able to do it for basically 2 years, but it's not common. I consider myself lucky. I bought another house 9 months later. I bought it for $550K. So I got a little bit smarter and I want to do more work. So we put in $100,000 of renovation. We sold it for like $850K-ish. The lesson on that one was we can build like 2 townhouses in the back. So I wanted to do more development. I want to do some renovation. So I was planning myself to do development. And then I sold it because I started the company Cashflow Portal and I said I could learn development, but I don't want to because I can only do one thing at a time. And it's better to learn how to run a company than learn how to do construction development. So I sold that a little bit prematurely and the IRR is 13.21. So one of my low lights, I guess. The other thing I learned on that deal though is we sold it to a developer. So they're very good at negotiating. So I was like, dang, I was just a retail investor selling it to a developer. So that's why my IRR is so low. That freaking developer never built anything and sold it, couple years later for 1.2 million. I was like, I was stupid. I made money, but I was stupid. I kind of redeemed myself on September where I bought a Airbnb, a townhouse, a brand new construction townhouse for Airbnb purpose. It was like in downtown Seattle or close to downtown Seattle. I bought it for $875K-ish and then I sold it in March of 2022 and I sold it for 1.175. We did Airbnb on that. So I spent about $25,000 on furnitures. We tried to make it a little bit high end. And just keep in mind, running an Airbnb is not easy. That's an understatement. Because initially, we didn't have much reviews. It takes a year to build that review base so that people trust those things a little bit better. I had to pay the 20% management fee, all that stuff. It was basically making some cash flow, but not that much. So my IRR on that one is 31.01%. Another property that crossed the 30% IRR mark. So yes, I was very proud of that. Then comes to the last property. This property is the one that I bought recently, a year and a half ago. And I bought it for $750K. I bought it actually in Texas because I was planning to move to Texas and then decided that Seattle has better Asian food. So I stayed in Seattle.
It's a good observation, well reasoned.
I bought it for $750K. It's worth about $850K, probably a little bit even less than that. I put in $80,000 of renovation. So I did the math on that, right? Remember, when I sell, I have to pay transaction fee, all that. If I sold it, I will have lost like $50,000 and my IRR will be negative 14.45%. It's an unrealized IRR, just to be clear, I guess to make myself feel better. I have not sold that, so it's not realized IRR. But if I were to sell it, yeah, I will have a negative 14.45% IRR. What's the range? The range is anywhere, negative 14% IRR all the way to 35% IRR. But the medium is about, 16% IRR. Now, take the Airbnb thing. Airbnb is 31%. I bought it at a very good time, late 2019. I sold it right before the interest rate starts hiking. This is one of the best times to hold anything. I bought it near downtown Seattle. I bought at one of the best periods in history, one of the best locations in the US where tech was booming, and I sold it before the economy crashes. My IRR is 31%. When you have spectacular results, IRR is above 30%. 30% IRR is like having a 4.8 GPA out of 4. I go through all of this stuff. Maybe just to make one last point. The reason I put in all these IRR numbers is to show, how does that compare with real estate syndications. I started with single family, bought 7 single families, did a 7-unit apartment complex. Then I start doing syndications. And then now I have more than 1,000 units as a general partner or lead general partner on syndications. On my first deal, the IRR is 29.33%. I bought the Airbnb at the same time that we bought that syndication. One is 31.01% IRR. The other one is 29.33% IRR. For the 31.01% IRR, it was an Airbnb. It was in Seattle. It was one of the best times in history. I had to do so much work. Bought the furnitures, did the design, make sure the ratings go up, answer a lot of random questions, bookkeeping, 31.01, and then we have 29.33 on my own syndication as a limited partner. That 2% extra IRR, is that worth my effort?
It was not worth it.
Because that's the most apples to apples comparison I have personally experienced. That experience, by the way, was the single biggest motivator. I am willing to bet my entire fortune, my entire startup idea on the future of real estate syndication. Because I saw that very firsthand that I can work my ass off, do Airbnb, not even long-term rental, Airbnb, which is supposed to increase cash flow, and do all this work. Or I can send someone a $50,000 check and then collect the dividends every quarter and read some monthly reports. One is financial stress, mental stress, emotional stress. Something could always go wrong. 31%. The other one is do nothing, like literally nothing for like 3 years. That's why I'm convicted that this thing works. Take any deal that you have right now, bought in Seattle, bought in the Bay Area. I will guarantee, tell me your IRR. And I'll guarantee that IRR is lower than the typical syndications IRR. In the bull market, in the down market, because you cannot compare something in a good market against something in the bad market. You have to compare within the same time frame. I have observed, based on my personal experience and based on many others in the syndication industry, being a passive investor on average makes more than owning single families. Another passive investment I made during the same time period, it triples my money in pretty much the same period, in like 3 years. So that IRR was like 37% IRR. That, based on my anecdotal evidence, my personal experience, is the driving force in everything we do, because we taste it. This thing works. It's real. I hope that more people can taste that difference and they will know, why am I even buying single families anymore? I'm not buying single families anymore. I'm investing passively. We can have another video about general partners. I make minimum wage as a general partnership, and that emotional roller coaster is not worth the amount that I make as a general partner. Passive investment has a close to infinity reward to work ratio. Again, passive investment has close to infinity reward to work ratio. If you know what you're doing, these are real world examples to show that if you just care about the returns, syndication is actually better. And if you care about work-life balance, syndication is way better. So what is preventing you from taking the jump? And if you want to take the jump, here is a video that you should watch. What is the single most important thing that you can do to start becoming a passive investor? Thank you for watching.